Next, introduction to industry and company analysis, EOC questions. First, which of the following is least likely to involve, mind the word, least likely to involve industry analysis? First, sector rotation strategy. Sector rotation is in fact shifting of investment assets from one economic sector to another, from telecom to maybe banking. So this strategy involves studying of fundamentals, studying of industry. So yes, it will involve industry analysis. Next, top-down fundamentals. Top-down fundamental investing. What does it mean? Top-down investing is an investment analysis approach that involves looking first at the macro picture of the economy and then looking step by step at smaller factors in finer detail. First, you study the overall economic environment, then you study the particular sector, and then you move downward. So this is called top-down fundamental investing. So it definitely involves studying industry analysis. Then finally, tactical asset allocation strategy. What it is? Tactical allocation strategy involves allocating your stocks, your bonds, and your cash in such a way so as to maximize the portfolio returns. Balancing and adjusting within the portfolio between stocks, bonds, and cash. So it's simply active balancing and adjustment. It does not involve industry analysis. So this is the one that is least likely to involve industry analysis, and that's what makes C to be the correct option. Next, a sector rotation strategy involves investing in a sector by making regular investments in it. No. Basically, sector rotation strategy is conducted by investors when they wish to invest in industries based upon the business cycle conditions. So it's basically investment where we as investment manager consider the timings when to invest in what industry depending upon the business cycle conditions. So the correct statement, a sector rotation strategy involves investing in sectors by timing investments to take advantage of business cycle conditions. Investing here, selling at the peak. Investing here and then selling at the business cycle reaches the boom. So that makes C to be the correct option. So C is the right result. Next. Which of the following information about a company would most likely depend upon industry analysis? Dividend policy is internal, so we're looking for the industry as a whole. Trend in corporate expenses, internal to a business. Competitive environment, yes, it's a part of your industry analysis in which the business is operating. We need to see the competitive environment through Porter 5 forces model and through Porter generic strategy. So that makes B to be the correct option. Next, which industry classification system uses three-tier classification system? If you've read your theory well, you will know that Russell Global Sectors, they use three-tier structure, whereas industry classification benchmark and global industry classification, they use four-tier structure. Then next, that makes A to be the correct option. Next, in which sector would a manufacturer of personal care products be classified? Healthcare, no, because in healthcare we have pharmaceuticals, biotech, medical devices, healthcare equipment, medical supplies, and healthcare services. We are looking for personal care. Then what about consumer discretionary? Consumer discretionary include automotive, apparel, hotels and restaurants. So this is not in the right category. Then it must be consumer staples. Yes. Consumer staples involve food, beverage, tobacco, and personal care products. So it would be B. An automotive manufacturer is most likely classified in which of the following industry sectors? Consumer staples? No. Why? Because consumer staples include food, beverage, tobacco, personal care product. Then could it be industry durables? Industry durables include heavy machine and equipment, Aerospace, defense, transportation, commercial services and supplies, so not here then. Then it must be consumer discretionary, if that we just discussed a little while ago. Automotive, apparel, hotel and restaurants, so yes, automotive is there. That makes C to be the correct option. Which of the following statements about commercial and government industry classification system is most accurate? Many commercial classification systems include private for-profit companies. True, but this is not true for government classification, because government classification includes not-profit organizations, so this is not right then. Both commercial and government classification systems exclude not-for-profit companies. Wrong. Commercials may exclude, but government classification include not-for-profit companies. So this is not the correct option as well. Commercial classification systems are generally updated more frequently than the government classification system. This is the correct statement. C is the right option. Commercial systems are generally updated more frequently than government systems and include only publicly traded for-profit companies. So that is the right answer. Next, which of the following is not a limitation of a cyclical, non-cyclical descriptive approach to classifying companies? Cyclical company may have a growth component in it. It's a true statement as well as it's a limitation that there is overall business cycle, a downturn, a recession, or a long term recession called slump, but some businesses might be doing well. So this is one of the limitations. Cyclical companies may have a growth component to it, which might go against the business cycle. A global company can experience economic expansion in one part of the world where things are good, while experiencing recession in another part. This is absolutely true. So even the company might be cyclical, but this is a possibility and this is the limitation. But look at this. B. Business cycle sensitivity is a discrete phenomenon rather than a continuous spectrum. This is wrong. Business cycles tend to be continuous. It is not discrete phenomena. Wrong. The cycle goes on like this. So it's a continuous phenomenon. We can't classify either or. So it's continuous. I have seen 3 business cycles in my lifetime. It takes about 8 to 10 years. Normally, that's the average time. 8 to 10 years for a business cycle to complete. So I've seen these 3 in my lifetime so far. Next. A cyclical company is most likely to have low operating leverage. Not necessarily. We can't conclude that. A cyclical company is most likely to sell relatively inexpensive products. We can't say that. This is not, it can't be taken for granted. A cyclical company is most likely to experience wider than average fluctuations in demand. Now that makes sense. Cyclical companies are sensitive to business cycle. So their sales peak at boom and fall to the lowest during recession or slump. So there will be a wide volatility in their demand, wide fluctuation in demand. That makes much more sense. C is the right result. A company that is sensitive to business cycle would most likely not have growth opportunities. Wrong. There are many firms within business cycle can have growth opportunities. We can't conclude that. Can't. Experience below average fluctuation in demand. Wrong. We just discussed in the previous questions. They experience above average fluctuation in demand. So this is wrong too. Most likely sell products that the consumers can purchase at a later date if necessary. Yes. Consumer can postpone their purchase. That's the reason such businesses are greatly affected by business cycle. And this is a true statement. C is the right option. Which of the following factors would most likely be a limitation of applying business cycle analysis to global industry analysis? Some industries are relatively insensitive to business cycle. True. Then exclude such firms from the analysis. Correlation of security returns between different world markets are relatively low. Wrong. Relatively high. That's why we go for global industry analysis. One region or country of the world may experience recession, while another region experience expansion. So this could be the limitation of applying business cycle analysis to global industry analysis, because one part of the world might be experiencing recession, another boom. So this could be a limitation, and that's why it's your right answer. Next, which of the following statements about peer group is most accurate? Constructing a peer group for a company follows a standardized process. There is no standardized process. It varies from analyst to analyst, from firm to firm. This is not a correct statement. Commercial industry classification systems often provide a starting point for constructing a peer group. That's a right statement. That's a correct statement. We use commercial classification providers to determine which firms are in the same industry. Then we proceed. That's our first step. Then we examine firms' annual reports to see if they identify key competitors. We use industry trade publications to identify competitors, and then confirm the comparable firms have similar sources of sales and earnings. So the starting point is we use commercial classification providers to determine which firms are in the same industry. This is true, most accurate. C, a firm peer group is generally composed of all the companies in the most narrowly defined category used by the commercial industry classification. Not all. Not all. So even the category is narrowly defined. We can't add all the firms. That's wrong. So that makes B to be the correct option, and B it is. With regard to forming a company's peer group, which of the following statements is not correct? Comparing the company's performance measures with those for a potential peer group company is of limited value when the companies are exposed to different stages of business life cycle. This is a true statement. The higher the proportion of revenue and operating profit of the peer company driven or derived from the business activities similar to the subject company, the more meaningful the comparison is. Yes, the comparator has the same or larger part of its revenue coming from the similar sources as your subject company. The more meaningful the comparison, it makes perfect sense. It's a true statement. Then comments from the management of the company about the competitors are generally not used when selecting the peer group. This is wrong. We just discussed a little while ago. We examine firms' annual reports to see if they can identify the key competitors. This is a wrong, incorrect statement, and hence our right answer. See, it's false because reviewing the annual reports to find management's discussion about the competitive environment and specific competitor is suggested step in the process of constructing a peer group, as I just said a little while ago. So A is the right answer. Next, when selecting companies for inclusion in a peer group, a company operating in 3 different business segments would be in only one peer group? Not necessarily. Company could be in more than one group, possibly be in more than one peer group. That's the correct statement. And not be included in any peer group, this is wrong. So even multiple business segments may make it difficult to classify the company, but yet it is possible to have such a company in more than one groups. So that makes B to be the correct option. Next, an industry that most likely has both high barriers to entry and high barriers to exit. Restaurant industry, well, it doesn't have high barriers to entry. All you need is a suitable place and little investment in cooking stuff and all that. So it's not the industry that has high barriers to entry. And it also has lower barriers to exit. So this is not the right option. Advertising industry, it doesn't require massive investment in running an advertisement business. So it doesn't have high barriers to entry or exit. Automobile industry involves massive investment in capital. That is the high entry barrier. And once you are into the auto industry and you want to close, it will be difficult to dispose of assets because these are or might be specialized assets, manufacturing facilities. So disposing them of would or may result in significant losses. So this means high barriers to exit. So that is the perfect option. C is the right result. Which factor is most likely associated with stable market share? Low switching cost. If the switching cost is low, your customers can move to the competitors. Your competitors' customers can come to you. So this would result in unstable market share. Wrong. Low barriers to entry. When there are low barriers to entry, the competitive firms or competing firms can enter the market and they can take your customers away. So you might lose your market share. So if the barriers to entry are low, market share is unstable. So these two options are incorrect. Yes, slow pace of product innovation. This could be the right option. A slow pace of product innovation means that there is little development in the product. So customers prefer to remain connected with you or with the competing firms. So the market shares tend to be stable. That makes C to be the correct option. Next, which of the following companies most likely has the greatest ability to quickly increase its capacity? For restaurants, you may need additional space. You may need to modify the existing space to increase capacity. So you maybe need to hire more workers, chefs, etc. So this is not what you can do in the short term. Steel producer, it will be even harder for a firm like this to expand capacity. You need to invest in large physical expansion. Plant capacity needs to be increased. It will involve substantial investment. So this will take time. It will take time. But legal service providers like insurance, banking, so your service providers can easily expand. They can scale their capacity up and down. So it's quite flexible for service providers. So C would be the right option. Next, a population that is rapidly aging would most likely cause the growth rate of the industry producing eyeglasses and contact lenses to, since older people will need this, they will need eyeglasses, they will need contact lenses. So this industry will see a growth. So we can say that a population that is rapidly aging would most likely cause the growth rate of the industry producing eyeglasses and contact lenses to increase, because the product demand would increase as the population age. So the industry size, the growth rate of industry would go up. B is the right answer. Vision typically deteriorates at advanced age. An increased number of older adults implies more eyewear products, and hence this industry's growth rate would increase. Next, if over a long period of time a country's average level of educational accomplishment increases, this development would most likely lead to the country's amount of income spent on consumer discretionary goods too. Now, if educational accomplishment increase, that means that workers will be skilled, their incomes level will go up. So when the incomes and wages are higher, they are more likely to spend on discretionary goods. Now, what are discretionary goods? Automobiles, clothing, hotels and restaurants. So the demand for or the income spent on discretionary goods would go up. So that will make B to be the correct option. Next, if the technology for an industry involves high fixed capital investment, then one way to seek higher profit growth is by pursuing what? Since there is fixed cost that needs to be spread on a larger number of units, so companies should seek economies of scale. What is economies of scale? When the business increases its scale of operations, there are many cost advantages. Average cost falls. Why? Because the firm will be able to expand its production and fixed costs will be distributed on a large number of units. The firm will be able to purchase the materials at discount price, called the purchasing economies of scale. The firm can employ professional managers who can run the business more efficiently. This is called managerial economies of scale. Business will be able to take on different sources of finance at lower cost of capital. Being larger, this would result in lower cost of operations, funding. This is called financial economies of scale. Risk-bearing economies of scale. Company can employ larger, expensive, productive, efficient machinery that will result in lower cost of production. This is called technical economies of scale, and so on and so forth. So that makes A to be the correct option, and A it is. Next, which of the following life cycle phases is typically characterized by high price? At maturity stage, firms will compete over price. In growth stage, they will too, but at embryonic stage, since the industry is in the initial phases, the embryonic stage is normally characterized by slow growth and high prices. So that makes C to be the correct option. In which of the following life cycle phases are price wars most likely to be absent? Price wars are frequent in mature industries, in mature life cycle stage. Declining stage, there will be more price wars in order to get the larger market share. In growth phase, when the industry is in growth phase, price war tends to be absent because the market is growing, everybody's looting the proceeds of the market growth. So price wars most likely to be absent in the growth stage of industry life cycle, so that will make C to be the correct option. Next, when graphically depicting the life cycle model for an industry as a curve, the variables on the axis are time and the industry output or demand, more appropriately demand and time. Demand on the y-axis and time on the x-axis. That will make B to be our correct option. Industry consolidation and high barriers to entry most likely characterized which life cycle stage? Industry consolidation is a situation in which companies try to act like one. Companies become one. It's sometimes described as mergers, acquisition, so on, so forth. There are various forms of business consolidations or business combinations. So this would happen in mature stage. Industry consolidation and relatively high barriers to entry are two characteristics of mature stage of industry. Which of the following is most likely a characteristic of concentrated industry? As we just said, concentrated industry means a market scenario where a few large companies have a very high market share in the business in that industry. So which of the following is most likely a characteristic of concentrated industry? Infrequent tacit coordination. In fact, if the industry is concentrated, there will be frequent deliberate non-action that are done in coordination. Tacit means they are not written, but the firms agree on action together. So there will be frequent tacit coordinations, not infrequent. The firms will act like one. Difficulty in monitoring other industry members? No. In concentrated industries, firms watch over one another. So rather there will be an ease in monitoring other industries members. So this is wrong as well. Industry members attempting to avoid competition on price. That's a true feature of concentrated industries. The firms in concentrated industries act like as if they are one, so they tend to not to compete with each other on price. So that would make C to be the correct option. Which of the following industry characteristic is generally least likely to produce high returns on capital? Least likely. High barriers to entry, as per the Porter model, it will prevent new entrants from entering the market, so existing firm will generate high return on capital. High degree of concentration, firms act like one, so they will make more money, high returns on capital. But short lead time to build new plants, that will lower the threat of mobility. Potential entrants will find it easier to enter the market because it takes less time to build new plants. Hence, there will be low barrier to entry. New entrants will reduce the returns on capital. So this is least likely. C is the right option. With short lead times, industry capacity can be rapidly increased to satisfy demand, but it may also lead to overcapacity and lower profits for existing firms. Next, an industry with high barriers to entry and weak pricing power most likely has high barriers to entry means that is favorable for you. Existing firms will be able to generate high return on investment. Weak pricing power, what does it tell us? Weak pricing power means that it is hard for the firm to find buyers. There might be excess capacity which might firm find difficult to sell, and it will be difficult for the firm to wind up the operations. So this would mean that the firm can enter difficulty because there's a lot of capital investment involved, but exiting such a industry is also difficult. So high barrier to exit. So industry with high barriers to entry and weak pricing power most likely has high barriers to exit. The firm will find it difficult to get out of the market. So that makes A to be the correct option. Next, economic value is created for an industry shareholder when the industry earns a return, well, not below the cost of capital. Economic profit is earned by the firm and the value for the shareholders is created when the company can return above the company's cost of capital. So your returns are higher than the cost of capital. That is when the value is created. So that makes C to be the correct option. Next, which of the following industries is most likely to be characterized as concentrated with strong pricing power, very highly competitive market, household and personal products, highly competitive, concentrated market. Alcoholic beverages, just few names dominating the market. So this is the market that is characterized as concentrated with strong pricing power. B makes it to be the correct option. Next, with respect to competitive strategy, a company with a successful cost leader or successful cost leadership strategy is most likely characterized by low cost of capital. Being a low cost producer means your cost of operations, your cost of finance are lower and you can sell the product at a higher margin because your cost structure is lower. So being a low cost producer means you have low cost of capital. Reduce market share, no. It's a dominant strategy will result in gaining market share. Being low cost producer or being producer of differentiated product, the ability to offer products at higher prices than competitors. Low cost leadership strategy follows that the producer, the firm has a cost advantage over its competitors and is able to sell the product at the same price, but being the lowest cost producer results in higher profit. That makes A to be the correct option. Companies with low cost strategies must be able to invest in productive, improving equipment and finance that investment at a low cost of capital. Market share and pricing depends on whether the strategy is pursued defensively or offensively. When conducting a company analysis, the analysis of demand for a company's product is least likely to consider the what? Motivation of customers base, yes, this could be the demand driver, must be considered. Product differentiating characteristics, how would it attract the customers? Company's cost structure is inherent and internal to the business. It could influence the pricing, but as such it is not what we consider as a determinant of demand of company's products. So B, C, R. A is the correct option. Which of the following statements about company's analysis is most accurate? The complexity of spreadsheet modeling ensures it doesn't guarantee the precise forecast of financial statement. There are many variables, many assumptions involved. So using just a spreadsheet doesn't guarantee the forecasts are precise. The interpretation of financial ratios should focus on comparing the company's results over time, but not with competitors. Wrong. There is always a comparison within the industry with leading competitors as well as the industry averages. So comparing over time is just one aspect of the story. It's not correct. The corporate profile would include the description of the company's business. Yes, what the business is all about. Investment activities, governance, strength and weakness. Without doubt, it's the correct option. So with this question, Introduction to Industry and Company Analysis, EOC questions are over.